The RBA left Australia's cash rate on hold at 3.6% in December, as was widely expected. But the story today wasn't about the decision. It was the shift in tone from the bank. It was one of the most hawkish statements and press conferences you'll hear from a central bank without actually raising rates. The RBA is now openly saying that risks around the inflation outlook have tilted to the upside. That's a clear break from the balanced language we've had for months. Governor Michelle Bullock also made it clear that the board is uncomfortable where inflation currently sits, and that if price pressures prove persistent, policy questions will be asked very quickly. The domestic economy is running potentially above capacity with more momentum than expected. Private demand is lifting, housing is still firm, and capacity pressures are building. Labour market conditions are also deemed to be still a little tight, with unit labour costs remaining elevated. Put together, it's a mix that makes the bank reluctant to cut further and more willing to tighten if necessary. Bullock said the board did not consider a cut or a hike today, but they did discuss the circumstances in which they might need to tighten policy. She also said that more rate cuts are not needed. Rate cuts are not on the horizon, and that the outlook is now for an extended pause or for hikes. That's about as blunt as the messaging gets. From here, everything becomes meeting to meeting. Labour market data will remain important, as will the November trimmed mean inflation figure due out on the 7th of January. Now, it's not the full quarterly print the bank prefers, but the detail will give a strong hint on whether the recent lift in underlying inflation has been sustained or has accelerated further. Unsurprisingly, markets reacted straight away to the hawkish tilt. 3-year Australian bond futures hit fresh cycle lows on the statement and the press conference. That pushed yields higher, helping to lift the Australian dollar not only against the US dollar, but also against the crosses. It also weighed on SPY futures. Rate pricing has also shifted meaningfully too. A February hike is now priced at just over 20%, and I'd expect that to rise further as markets digest today's shift. May is sitting above 80%, and the first move of the cycle is fully priced by June. Before today, that was in November. Barring a calamity in markets or global economy, the easing cycle is now over in Australia, and the next move is up, and February is very much in play.